Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, August 3rd, 2023. It's 9:55 a.m., so the markets have been open for almost 30 minutes, and I wanted to get this one out, kind of give you not the everything I'm watching, but things that I'm watching, opportunities where I think the opportunities might lie, also considerations in your trading and investing. And starting out with this QQQ, which I usually do. Remember, we have two of the biggest companies, or the biggest publicly traded company in the world, Apple, and then right behind that, not far as Amazon, both reporting tonight. So almost certainly going to move the market one way or the other. Again, I always say this, but it bears repeating. Don't put too much into the initial reaction. That's not always the one that sticks. They report after the close. Then they'll do their conference call and all that. Market will then react to that, and then it often takes a day or two for the market to fully digest everything. And of course, they're going to report today after the close, which is Thursday. So we'll first and only full trading day this week will be Friday, and then we'll see where we carry in the next week. All right. So the takeaway is a couple takeaways. Number one is expect volatility today, whipsaws and all that. That's common before any major market moving events like a Fed meeting or big companies like Apple, especially Apple and Amazon, both reporting on the same night. This is my QQQ chart. I shared with you my preferred scenario. I gave you an alternative scenario, which has us coming up back testing. You can see there's a nice downtrend line as well there in yellow. There's our primary uptrend line. And as I said, and this isn't just, I sometimes get the comments, all these different scenarios. I clearly make it known which I prefer in an alternative. This one, I can see the possibility. And of course, anything's possible in the markets, but I speak in probability. So most probable, second most probable, back test, then a reversal, and then third most, anything else I'm just wrong. And that's this one would have us pop up. Market likes what Apple or Amazon selling, but I had to make clear now that we have the indicators are lagging so much that any new high, when I bring these indicators across, or the divergence lines, we're still going to have, it would be guaranteed if it happened tomorrow, early next week, that we would just extend the divergences again, and it's not going to change the technical posture. One thing I will say, it will mean that this breakdown was a whipsaw. Now on that, I often talk about pre-Fed and pre-earnings, big market moving earnings, the increased chance for a whipsaw. I've seen this, been doing this a long time, and I've seen it before. So, these breakdowns, take them with a grain of salt. I know I said way back when, for months I was saying when this trend line goes all the way back here, that would be, not I don't know if I referred to it back then as an all-in moment, much more aggressive. Well, the breakdown happened to occur right before the those two big companies report, which to me, now that's just me, officially closes out peak earnings after today, after Amazon and Apple reports. There's not much else that's going to move the market, or it has the potential to move the market as much as them. So what I'm getting at is we'll kind of have, I believe, some clarity in the next few sessions. That'll be Friday, Monday, early next week. I made clear which way I think things are going. And, if you get a back test, we're not talking about much, percentage terms from where we're at right now, 2%, something like that to back test there. And then a marginal new high, what would that mean? That would be, about 5-6%, somewhere in there maybe. Okay, so that's that. I also shared you this one. I've zoomed out now to the 2-hour candles on the NQ chart. It shows that trend line pretty clear, and I gave you a more of a cleaned up version, if you will. I said I marked the key levels. So what does that mean? Okay, that would mean to me, if you're not a very active trader and you don't game little zigs and zags, then these would be the targets I would hold out for and expect reactions on these thicker lines down here. And ultimately coming down here, this is where I think, at least near term, that we're heading. And we could certainly go down more if we get there. And I will probably be adding additional targets, and I'll tell you right now why, because that's going to then do some things on the longer term daily and weekly charts that may indicate more downside and help to solidify that case that this just may be one big bear market rally we've been looking at since really the beginning of the year, mostly in the Nasdaq, October 15th there. So we'll see where we go. And again, not an all-in moment yet because of what's going on, of course, with the earnings tonight. All right. Short term, remember, if you are an active trader, there's a lot of money to be made long and short. To be completely market agnostic, I like to have no, bull, be thy neither bull nor bear, and just swing this little 5-minute chart. I show this all the time. This is what I'm doing most of the time, but these aren't trades. This is fast moving stuff. So you just look for these divergent highs and divergent lows and swing these little micro trends is what I call them. And here's what we did this morning. We went down there, and I don't believe I've modified these lines. This line was created back on July 19th, and I haven't modified it since. I've shared this chart with you many times before. So you get a divergent low at support, and you go long. That's where you're going to get a bounce. And we've had a bounce so far, and that would have, you could have covered shorts and or reverse long. It's an active trader, made 0.7% so far. Now, that's about it, because you have this, or at least where I think it's prudent to take some profits. That's a resistance zone. It was a former support zone. We had a gap right here, a lot of reactions right there, and so that's it. In, out, maybe back to short, but I think that's just a very good price target. We could see a little bit more, but again, the trend has been for the last few days. This is the last few days here. When we look, this is a 5-minute chart, and we've seen it really since the big fangs of the other big tech stocks started to report. We have Microsoft out of the way, Alphabet, Meta, and on balance, we've seen more disappointments than we have seen positive results. And so far, so you see this, what I've talked about, nervous profit taking. I mean, those stocks have run up so much. What are they going to do at this point? You're going to see, it's possible we could have seen a ramp up into earnings, but we've seen more of a, since back here, since really earnings started, this was, you go down, here's my dates down here. That was the 19th of July. We've been stair-stepping down. Anyways, so that's it. That's the current and very near-term trend right now. All right, the intermediate trend is still bullish. That's the trend off the mid-October, or in the Nasdaq more around when the fangs bottomed in the beginning of 2023 in January. All right, so the takeaway is just we'll have that more of a all-in moment, if you will, after these guys report and over the next day or so. But remember, I had a lot of evidence, a lot of price alerts firing off in the last couple of days. I'm going to go over that. I'm also going to speak to this real quick. Somebody asked me, I saw a comment today from one of yesterday's posts, the video, what's your favorite short trade right now? So my answer was, there's not any one stock that stands out that's screaming like, oh my God, I love this short, this is it. If there was, I would tell you. But I also have to throw caution to that, because I know for a fact from reading the comment sections, I had some trades that went bad a few months back, shorting the semis too early and the Nasdaq 100 too early. And from the comments, some people said they lost a lot of money. And so that shows improper portfolio management, diversification, position size, and etc. You don't put all your eggs in one basket. I don't care how good, how bullish your favorite individual stock setup looks, or even if it's a sector, or even an index. Diversify. So my answer was, and I'm going to go over that now, I've shared what my favorite sectors are recently, and even indexes. So indexes, QQQ, but I also said on that, I think you get more bang for your buck shorting tech only, be more narrow, and XLK is your tech ETF. And then within there, you can get even more narrow and short the semis. And then in that reply that I made, I also said, if I'm correct on where things are going, you'll probably have more bang for your buck shorting or buying one of those inverse FANG ETFs. I think FNGD is a 3 times short, and that has a concentration of the big techs, Apple, Microsoft, Alphabet. And so all that, QQQ, XLF, one of those FANG ETFs, XLK, I should say, the tech sector ETF. I keep saying XLF. I always get those two. It's a little backwards thing. Anyways, XLK, the tech sector ETF, they're all overlapped. So you don't, in other words, you don't want to short QQQ, XLK, SOXX. They're all concentrated. Again, semis are a subsector of tech. Tech is the largest sector within the Nasdaq 100. So, pick one, pick the others. However, the more concentrated you are, and that's what I tried to convey in that response that I made. If you went with a FANG, shorting the FANGs only or tech only or semis only, you'll probably outperform, make more money if I'm right on where I think things are going. But it cuts both ways. If wrong, maybe they rally more and you lose more money. They're just less diversified. That's the bottom line. Than shorting an index. Now, with that being said, okay, I also mentioned, and I've been repeatedly highlighting my favorite sectors, which are the restaurant stocks, and then, in the last couple videos, I've expanded that to pretty much all things leisure, the consumer's resilient, they're going to keep this economy going forever, they're going to prevent us going into recession, that whole thing, if you will, has reached a crescendo in my opinion, and is old news now at this point, and probably the next good trade on the short side. So I've made the case, I can make it fundamentally all day long, looking at, which I did briefly, showed you consumer credit, now to consumer credit, knowing where we are. So we've had this all-time highs in consumer debt, in credit cards and other consumer credit. And that debt's, now rolling over at, we've got 5% money markets and CDs now. Banks don't make money by paying you more than they lend out. So banks make money on the spread. And that's what the difference of what they pay you on your deposits and what they lend out. So bottom line is these loans, credit card balances and car loans and all that, mortgages are now, being taken out at 7, 8, 9, 10, and in some cases 25% on the credit card debt. So yeah, good luck to the whole, consumer trade holding up. Anyways, that's my thoughts fundamentally. Now, at the end of the day, I'll give you my fundamental thoughts. You take them for whatever it's worth, but I've given you hard trade ideas, and those are based on technicals, and that would be, if you want just a one-size-fits-all, I told you it's thinly traded before, but EATZ, EATZ is the restaurant ETF. I also like, and that's why I do these 30, 40, 50-minute videos, because I feel very strong on, instead of going with an ETF like this, pick the most bearish ones. And, some of those I've highlighted recently. I had 2 alerts today. I had a Jack in the Box go off. Now, it's when I get an alert, I look at it. See, Jack in the Box just hit my trend line. I have an alert at the trend line. It kissed it. So it's not there yet, but ready to fire. So in other words, where are my favorites? Well, this one. You take a half dozen, a dozen, whatever you can manage. And this is a sector I certainly like. So what I'm speaking to again is diversification. I might be short tech, also short restaurants, and I might be long some other sector. And certainly when it comes to diversification, and again, in my response to that question was not just, hey, don't put everything on your favorite short if you think the market's going down. Diversify among different stocks, sectors, and that's just the equity component. Let's not forget about asset allocation, the single most important thing in both investing and, in my opinion, in active trading and swing trading. And what is asset allocation? That's just spreading your money among the different asset classes. Asset classes are equities, which are stocks, are one. Bonds, fixed income, that's another. Commodities, and within commodities you have a whole different spectrum. You have agricultural commodities, industrial commodities, metals like copper, and then you have your precious metals, silver and gold, oil, natural gas. So I'll talk on those real quick. So to me, that is a much more a well-rounded portfolio, because one day you're going to get clocked on your semiconductor short trade, but you might be making money on natural gas. Okay, let me rifle through the rest of these. So Jack in the Box, McDonald's, that one's already triggered right there. Remember, I gave you this one as official with some targets, and there were a lot more there. Some have already started moving lower. Okay, so like I said, you can go with the EATZ. Know that it's thinly traded, but if you're holding it for a while, that shouldn't matter. Just try to enter a thinly traded ETF using market orders instead of limit orders. I'm sorry. I'm sorry, I said that in reverse. Limit orders instead of market orders because of the wider spreads. But then most ETFs are going to do a good job of tracking their underlying portfolio. So if you don't want to day trade a very thinly traded ETF, but you can swing trade it as long as it does a good job tracking the portfolio. So EATZ is there, and then the other one for you. So yesterday and in recent videos, I started highlighting the casino stocks as another one of my favorites. This is BJK. So if you want a one size fits all, again, you decide to allocate a certain percent of your portfolio, whatever that is, 5, 10, 15, 20% to shorting casino stocks. Well, you can go with the individual ones, or you can go with BJK. BJK, just like a lot of stocks I highlighted recently, including Tesla, and what was the other big tech, one of the big Intel, and did the same thing, hit their bear market down, had a very similar chart. Bear market downtrend line off the highs, rallied into it, and did so with negative divergence. That's my kind of setup. So there's an objective short entry and also price resistance to boot. There's a trend line. But again, this is wash, rinse, repeat stuff. See this right here? That was a divergent high. You got this. This was a divergent low. You got this. This is a divergent high. I think you'll get this. So that is an ETF. Again, safety in numbers, diversification, or you go with the individual ones. Las Vegas Sands already had a bearish rising wedge, broke down, and it's pushed back to. You can see it's in a little trading range here, and it's at the top, coming off the top of that trading range. So this one's still objective. It will go down, and eventually, I believe it'll break the bottom of that trading range and run down to this next target there, about 48.50. There's other ones out there. I'm just going to rifle through these in no particular order. MGM, look at these starting to come down. I highlighted this one right here the other day as an objective short on that previous rally right into the previous all-time highs right there. Negative divergence, almost an identical setup, and then boom, if you shorted that one at 51 or so, now you're already up about 10% in just a couple days there. Yeah, that's the first target. So do you short it right now? No. If anything, you cover it, take the quick profits, wait for a bounce. There's a gap there. It might want to back test, or you wait for that level to clearly give way, and then your next target is the uptrend line. And then based on this pattern, I think ultimately this breaks, and it's going to go down a lot more. So just wanted to mention that these are rolling over. This is, I've been talking about how, the consumer trade, the consumer leisure trade, leisure stocks, restaurants, hotels, casinos, airlines, they were in my radar, and now we're starting to see quite a few of them break down. So that's it. So there's Caesars coming off, Wynn, Churchill Downs, I mentioned the other day, Boyd Gaming. Look, there's an objective short entry, just broke down right there. IGT coming off that divergent high. I didn't even mark it up. All right, so that's it. So again, you can go with the individuals, or you can go with an ETF and keep it simple. All right. And then in case you missed those videos, PEJ is kind of more of an one size fits all for the leisure and entertainment sector. I told you before, it has restaurants and airlines, everything I just talked about, that whole consumer going out and spending in the service sector, casinos, airlines, hotels, restaurants, and all that good stuff all in here. So all right, so that's it. So again, it's all about, if you agree with any of these, and you don't need to. You might be bullish on tech right now, and then you agree with this, so you're long tech, and then you're short this sector. But this is like everything. This is what asset allocation, this is what a portfolio should look like, whether it's a trading account or a long-term, investment account. And you're going to have your commodities in here, maybe crude oil, natural gas. Let me get to those. Let me roll into those real quick. So USO, remember, this is probably the king of inflation trade. If there's one thing out there that you're going to track, and you can do it in real time to try to see what the Fed's going to be forced to do, this is it. Crude oil. Fewer things have a bigger impact on inflation than crude oil. So like I said, it's been running up. It's had a near vertical ascent. So I would be really surprised if we don't have a hot CPI print for the month of July with this. Like I said, we've had, these other months where you go up, down, you finish the month, a little up, little down, but this is just a straight ascent. And again, we're pushing on a key technical level resistance here. We potential bearish PPO crossover, probably corrects soon, but if it corrects and comes back and they step in and buy it, or it just keeps going up, bottom line is every tick up from where we just were, the markets are going to start to be increasingly hypersensitive on this, as well as the other thing I've been telling you to watch, and that's Treasury yields. TNX is the 30-year, the 10-year U.S. Treasury bond yield. Boom, has broken out of that 4.085 resistance level, big level there. It's not lights out yet, but this is in focus now. I said it would be before it happened. Now you're hearing about it. And before that was, I started, telling you really watch this one. This is one to keep an eye on. That was before 2 days ago where Fitch downgraded the U.S. Debt, and now everyone's watching that. And of course, what happens? It doesn't always happen, but so far that has been the case. So interest rates have been rising. Again, and that the inverse of that is IEF. If you don't have the yields on your charting platform, you can track IEF, the 10-year bond. You can see it's breaking down below a comparable support level, and this is it. I mean, that was the peak. That was the trough right there, or the peak in interest rates when rates were going up. That's and I've said this many times. It is far, far, far from mere coincidence that the stock market bottomed in mid-October, and we've had this bear market rally since, because I said this is all about interest rates and the inflation trade. So interest rates peaked. Again, this is inverse when you're looking at IEF. You can just go to TNX, and this is where interest rates peaked and the stock market bottom. And interest rates are falling, and everybody said the Fed did their job. Mission accomplished. They've killed inflation with rate hikes, and now this is kind of rut-row, and so no bueno for the economy, no bueno for the Fed. All right, so that's that. And again, it's all interchange. That's why I do these 40, 50-minute videos. These are the things you watch, and when everyone's high-fiving that the Fed's done the job, and then all of a sudden you start seeing commodities, especially those with the biggest impact on inflation, start to go the other way. That bears watching. Now it all could be just a spike up, and then if crude does this and interest rates do that, then that's good. That will help to support a case for the fact that we're going to avoid a recession altogether, or maybe have a mild soft landing. Again, these are the things to watch. That's all I can tell you right now. You can trade them if you want. These are more of and this one, USO. Let me tell you, I like UNG right now better. Natural gas continues to base here with that big divergent low. We have this 655 support we just bounced off of. Like I've been saying, we need to clear this T2 level to really run about $8, $7.95. But I do see some value here. It's been more of a in and out trading vehicle lately. It's been choppy, certainly not a trend or really much of a swing trading, just quick swing trades. But I just wanted to say I do like this, and I think this one has more upside potential than crude, in my opinion, right now. But and it will also, even if you don't want to trade natural gas, which I often call the widowmaker, I get it, very volatile. This thing, when it runs, it really runs, and when it falls, it can really fall. If nothing else, just keep an eye on it along with crude oil for that whole inflation thing, because rising commodity prices, especially energy, is going to make it difficult for the Fed to stop, stop tightening. Okay, let me just update the grains. Wheat's kind of pushing where it should pull back, but I think the case is still there. Remember, we had bigger picture. We had this, we can make a case going back to long-term charts on just about all commodities, including wheat, that they ended a bear market when the stock market bottomed with COVID, and they've had embarked on a new bull market. This was and still is excellent support on the long term, about $6 on the wheat ETN right there. Very good long-term support. So we had a big leg up with a blow-off top. That was Ukraine, Russia's initial invasion, spiked wheat prices. And then we had what I believe to be a corrective wave correction. and a new leg up. There's your downtrend line on the weekly. So this is kind of bigger picture, and this is still where I think wheat's going higher. On the daily chart, we'll zoom in a little bit here. We had, put in that divergent high, and then you had this big bullish falling wedge with positive divergence. We broke out, hit the second target, pulled back, back tested, hit that again. That established this resistance level, which I said we would now have to take out. That's then the level to watch because we had two distinct reactions on it. And when we hit it, caution, there was some negative divergence, which has since played out. That divergence most certainly has played out for a correction, and it's taken us back to roughly this uptrend line. And again, I can't make a screaming case to buy it here, but I think it's a good chance. When you look closer, this is a 60-minute chart. Remember, the futures will tell you a little bit different story, and they still look okay. So these are those little, 60-minute divergent high, but we're coming off this big divergent low, and we are still in an uptrend, near-term uptrend, I'm sorry. This was a downtrend. A downtrend is simply defined as a security making lower lows and lower highs. That was a downtrend. And then an uptrend is a series of higher lows and higher highs. So far we had about an equal high right there, but we have so far higher lows. And so if we can reverse soon, then the case is made and we run up there. And we've already double tapped that level twice. We'll probably go ahead and break out if and when we get there next. So again, I cannot make a screaming case to buy it, but I can tell you there's a steep downtrend line. We pop that, it's probably going to want to run. So there's your update on wheat. You want to watch corn as well. With trading wheat, they tend to trade together. And same thing, hit that divergent high, divergent low, rally, divergent high, correction, etc., etc., etc. Corn has this downtrend line right here. Had a little false breakout, false start right there. Went back down, but put in this big divergent low. We've been diverging just like wheat for quite a while. So we're coming off a very strong, powerful divergent low. And we ran into that trend line again recently, got rejected. So really needs to power up and through that trend line. As far as stepping in now, again, just like wheat, I can't make a strong case, but I'm going to move this line a little. Why did I do that? We have these reactions here, here, and we're right about there. We're hair through it. What you'd want to see, maybe wait till it recovers that level. So this is a whipsaw. That's about 22.71. And if you get that, that might give us another thrust up there. And then set a price alert if that level gets taken out. That's going to be pretty powerful. Alrighty, silver and gold. Well, let's just talk about the euro because that affects silver, gold, and the stock market. So long term, on the daily chart, we have this big divergence, negative divergence that we've been building on the euro. Talked about that recently, and that certainly played out for a drop in the euro. Now there's some support we're on right here. Next horizontal price support's down there. We had divergence up to this point here. At this time, we put a slightly higher high in the RSI, so really almost divergence there, close enough. And that would indicate a lot more downside in the coming weeks to months, probably down to about right here, I think, at least 105. That's, I think, why I color-coded that level, 105, 288. And remember, I've shown you, if you didn't see it, you can do this yourself, overlay EUR USD, or you can use FXE, the Euro ETF, overlay it against the stock market, and you will see a very tight positive correlation, meaning they both go up and down together. And the same thing, and that correlation's even tighter with silver and gold. So to be bearish on the euro would be to be bearish on the stock market and gold and silver. That's the daily chart. Near term, 60-minute chart, well, I got to point out we have some positive divergence right here. And that could give us a pop. That would most likely coincide with Apple and Amazon pop in the market tomorrow. After they report tonight, there's pretty good resistance right here. I think that upside on that wedge would be limited, but I have to point it out. So there it is. We have a bullish falling wedge, or at least positive divergence, and minor. The trend line's not great. I have a okay 1, 2, 3 reaction trend line. That's the minimum in my book. 1, 2, 3 reactions to validate a trend line. But we do have that divergence. And again, wash, rinse, repeat. Right here. Let's start here. Divergent high. Correction actually went down to here. Divergent low, bullish falling wedge. There was your breakout. That was your divergent low. Then you broke out, ripped up here, put in a bearish rising wedge, with a divergent high. There's your breakdown. You did this, and so we could something to watch. In other words, not a time to get aggressively long or short the metals. And now, here's the thing. Sometimes these divergences don't play out. Sometimes a bullish pattern, maybe you get a breakout and then it fails, and that's pretty bearish when that happens. So if we go ahead and take out these divergences, it's get out of dodge time in the market, and probably not a good time to be long gold and silver. But right now, like I said, we could get a little pop here, and a pop in gold and silver. And that whole correlation with the stock market, it's been mostly on correlation, but sometimes it can be on and off. So at the end of the day, and I love to be right for the wrong reason sometimes in the stock market. So we could do this. Euro could break out, rally, gold and silver could rally, and the stock market could go down. So like I said, it's been a mostly on correlation, but overall it's an on-off correlation. The correlation between the euro and the US dollar is with gold and silver is a much tighter correlation. That's simply because they're priced in those currencies. You're buying gold, GLD, the ETF, or gold bullion here in the US and in some other parts of the world being sold in US dollars. So if the dollar is weakening, it's going to buy less gold, and it's going to cause the price to go up, and vice versa. Okay, right at the 31-minute mark, so let me wrap it up, get it out to you. And I don't think there's much else to add. If there's anything I missed, any updates you want, drop it in the comment section. I'll be glad to answer those questions. But as of now, kind of intermediate, longer term, keep an eye on Treasury bonds, crude oil, natural gas, things that could really put the brakes on this market. And that goes both ways too. You start to see an abatement in those inflationary forces. That's a net positive for the market typically. But the caveat there is sometimes you can see those things falling from demand destruction. If the stock market really craps out after Apple and Amazon, if those divergences and overbought conditions and the bearish technicals that I've been highlighting on the big fangs play out for a big drop in the market, you're probably going to see crude oil go down with it as well. So that's how it works. A lot of moving parts to this stuff. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.